It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal, to help cut through that noise to navigate the best moves to your portfolio. Now, shifts in credit dynamics in the current U.S. geopolitical landscape may call for a different approach to safeguarding your assets right now. So what's the best way to play your asset allocations? Let's bring in Sound Planning Group CEO David Stryzewski. David, let's start out with your buys here. And you like the metals, and specifically what you like, David, gold and silver. Your first reason here, Dave, let's walk through these points. When you look at the gold market, what you see is that it hit an all-time high, and importantly, you say it stayed above there.
Yeah, that's right. So since 2020, there's been 4 different times that we have, neared these all-time highs, but not broken above. Really big deal here on March 8th, we broke above. And so as we've broken above those levels, that means that there's more room to the upside.
God, second point here, Dave, when you look at the gold market, what you're pointing out is you think what was a ceiling is now actually a new foundation.
That's right. When we break above 2100 and then stay above, especially as a week close, that has now become our new foundation or floor. And so I don't think that we're going to be going below 2100 from this point forward. It's just up from here.
Got it. And finally, talk about the role of central bankers.
Okay, so ultimately, the reason why the prices has been going up is not because advisors have been allocating inside of 60-40 portfolios into gold. There's not even 1% allocated there. The reason why it's been going up is because of central bankers like China that have been buying thousands of tons of gold on an annualized basis. Now, China doesn't do anything in secret. They're ultimately trying to let everyone know here that this is something that they think is very important, and they're buying thousands of tons of it.
Now, so those are 3 reasons before everybody piles in. David,
that's right.
What would be, viewers are thinking about making a move into this metal, what would be the risks that you would point out?
Well, because the U.S. dollar prices gold, the dollar is ultimately, if it gets stronger, that means that the value of gold goes down. But what we're seeing right now is inflation still continuing to rise, and so the opposite is actually the case. Gold has gone up while the U.S. dollar has actually lost some of its purchasing power.
All right, so let's turn to what you don't like here, David. So
sure.
let's talk bonds, specifically the AGG. Let's go through those reasons as well. Your first point here is, frankly, our expectations of when the Fed's going to cut and by how much they've been shifting.
Yeah, if you just even look at the price movement this year alone, we started out the year with 6 Fed cuts priced in. Now we're looking at maybe a couple. I think that might even go down to 0 if inflation continues to peak up. And so ultimately, if you own bonds, there's a seesaw effect. If interest rates rise, the value of bonds go down. This is a part of the reason why so much has been lost in bond portfolios, AGG specifically, over the last 3 years. We're actually negative. Still 316 this morning.
You're in good company, by the way. You've seen some noted economists, by the way, also telling their clients we think there's increasing chances of no cuts. Your second point here, let's just talk about yield.
Yeah, so, if the yield on the AGG is 3.3%, that's one of the reasons why you would own it, is that you could get paid. Now, the challenge is today that they have to compete with U.S. treasuries that are not only safer, but even on the shorter duration, so less of that swing risk there with the interest rate movement, you can actually get a better rate of return. And so I think that a lot of the corporate bonds right now just don't even look nearly as attractive as the safest place, yielding higher, shorter duration.
Final reason you would steer clear, you just talk about, frankly, refinancing costs.
Yeah, that's right. So ultimately, we're looking at a world right now where corporate debt is having to remetabolize this debt at double the cost of what it was, here in 2019, 2021, when every good CFO, got as much debt as possible. And now they're at this point after 5-year terms that they're going to have to refinance this. And so everyone wants lower rates, greater liquidity in the banks. The challenge today is that rates are twice as high, and there's not as much liquidity right now in banks. So I for sure see Chapter 11 is going to be coming strategic defaults. And of course, the downside with that is that if bonds have defaults, you actually get 0 back. You lose it all. So is that really the anchor that everyone wants to be focusing on right now when we're at these all-time record highs in U.S. markets?
And let me ask you, it's going to be the same question, David.
Sure.
What is the kind of risk to your call, the upside risk here?
Yeah, so the upside risks is that, if rates trend down, the Fed was forecasting 6% or whatever on the year, at least the duration on that AGG portfolio is about 8.5 years. So you actually would make money if rates dropped. It's just that the sentiment right now and where we are today, with unemployment where it's at, CPI rising, all these things, it is not very likely that the Fed is going to be able to reduce rates in a meaningful way unless something significantly breaks, which would actually be pointing to AGG, and then I literally wouldn't want it anyway. So
All right, David, let's sum this one up for investors because there's a lot to go over there. So you're telling investors, listen, buy gold and silver as they are one of the few asset classes offering both exceptional value and promising growth prospects. On the other side, though, you're saying avoid the U.S. Aggregate Bond ETF that's amid a lower outlook on a Fed pivot, the option of yield from treasuries, and the risk of holding corporate debt. Thank you so much for watching Goodbye or Goodbye. We're bringing you new episodes 3 times a week at 3:30 p.m. Eastern.